Happy New Year, everyone. I hope you all had a great holiday season here. This is your December/end of the year market review. So the reason that I put these videos together each month is to get you the straightforward information with no media spin, political angle, or fear tactics that many media outlets use to get more viewers to watch their shows. My goal with this is to just give you the information about what's going on in the stock market and the economy, and then ultimately how that affects your money and your investments. Stocks for the year of 2021, all were up across the board. If we're looking at the major indexes, the S&P 500, which is the 500 largest companies in the US, the publicly traded companies in the US, that is, was up 27%. The NASDAQ 100, which is the 100 largest companies in the NASDAQ composite, that was up 30%. Small cap stocks were up 16%. The Dow Jones was up about 19%, so that's what most people are tracking at the end of the day. If the Dow was up 100 points, down 100 points, so the Dow did well this year. Corporate bonds, though, and government bonds were both down about 1 to 2% overall, and the two top performing sectors in 2021 was real estate, which was up about 45%, and energy stocks, which was up over 50%. So both of those, real estate or REITs was more specific towards commercial real estate, and energy, going back to the REITs, that was because they had dropped off so much during 2020, so that was a good rebound for them in 2021. Energy stocks, they went up dramatically, and we'll talk a little bit more about that in detail here with some different charts, but energy stocks went up pretty dramatically because of oil prices going up so dramatically. A couple major highlights for 2021 as far as the economic highlights go was number one, inflation surging to close to 6%. So kind of going off of what I just talked about with energy stocks doing as well as they did, that's because oil prices surged from where they started about a year ago at around $50 a barrel to above $80 a barrel. And you can see here in this chart the fluctuations along the way. The other highlight was the continued recovery in the economy led by lower unemployment, which is currently sitting at 4.1%, close to where it was in end of 2019, beginning of 2020, before everything happened with COVID. Consumer demand also was very strong, and a lot of that is just because so many people was able to save money during 2020. They got government stimulus. People with kids got the child tax credit. So all of those things help people out as far as cleaning up their own household balance sheets, saving more money, paying off debt, and it allowed them to, from a consumer standpoint, if they were able to do that and clean things up, or just potentially save that money completely and invest it, that was helping out the economy in one of two ways. They were either investing that money or they were spending it. So both those things were big highlights for the economy in 2021. So I have 4 different charts that I'll go through today. The first one that I'm going to talk specifically about is a chart, and these are just charts. If you've never seen my monthly market reviews before, I go over these charts because I feel that they're a good way for me to talk about what's going on in the economy and the stock market, and then how that affects your money. And I like it just because it's a good visual. So the first chart that I have, I thought was interesting because it shows the rates of return for the S&P 500 there, that was the lower line there. Then there's US crude oil prices in the middle, and then Bitcoin, which was fluctuating pretty dramatically throughout the year, and still ended the year on a very high note, up 60% from where it was a year ago. So I thought it was really interesting just because those are 3 different types of asset classes that aren't generally very correlated together. So stocks being the 500 largest stocks, that was a pretty straight, not a whole lot of volatility in the stock market at all this year. The biggest drop-offs that we ended up having in the year were no more than 5%, and there was only 4 of them. So, it was a very steady type of year that we had within stocks. Oil prices, a little bit more dramatic moves, which is pretty typical with oil prices, but the Bitcoin price, which now Bitcoin has become more and more of of its own as a cryptocurrency has become more and more of its own asset class, and Bitcoin being the largest cryptocurrency out there as far as asset, or money in, a specific cryptocurrency. The swings with that were just so dramatic. So, you can see in the very beginning of the year, it spiked up in the first 3-4 months of the year about 120%, to then drop down to almost, break even for the year by the middle of the summer, to then rebound back up again. And then in the most recent couple months here, we've been in another drawdown of about 60%. So, I get a lot of questions from people about investing in Bitcoin cryptocurrencies, and I think that there's definitely a place for it. And it can definitely be part of a portfolio. I wouldn't make it, some huge percentage of your portfolio, for the reason of looking at that chart there, is that if you're going to just buy and hold it, you're going to go through a whole lot of fluctuations, which may not be, your specific risk appetite. So it's something that I may incorporate more and more within portfolios here in 2022, and more likely will. So, we'll talk more about that specifically, but I think that's a good way to help diversify portfolios, because as you can see, Bitcoin and US stocks don't move in the same direction at the same time, and they don't move in that same direction at the same magnitude either. So I thought that was an interesting chart, kind of showing some of the swings within some of the major investment asset classes out there. The second chart I have is a chart that measures the daily price to earnings ratio of the S&P 500 since the end of last year. So the price to earnings ratio is probably the most basic ratio out there to really actually see, well, how expensive is a stock, or the stock market in this case. So I hear a lot from people where they're concerned because stocks are at an all-time high, and people think just basic laws of physics, what goes up must go down. That's not necessarily the case with stocks, and over time, historically, it's proven that it isn't, because the way that stocks grow and they make money is based on the amount of money that they earn, so the profits that they make. And then there's the stock price that then is correlated to that profit, and that net income generating asset being the company. So the stock price in this example is taking the earnings, or the stock price, and dividing it into the earnings, and you come up with a ratio. A year ago, the beginning of the year, was a little over 22 and a half, almost 23 times the earnings, which means that for every dollar of earnings that the overall S&P 500 made, that would have made the stock price about $23. So versus that $1 of earnings that was out there. So this ratio is used a lot when you're just comparing specific stocks in a general sector versus another stock in that same sector. It's not as easily comparable when you're comparing different sectors, but this takes a very broad view of looking at the overall market, and just shows that over the year, despite the stock market going up 27%, or the S&P 500 going up 27% this year, that those stocks actually got cheaper throughout the year, because it dropped from 23 down to closer to 21 times earnings, which that just means that stocks are now cheaper than they were a year ago, because they're now earning that much more money. Their earnings outpace the price movement itself, which is a good sign overall. So I bring this chart up because first off, I thought it was interesting. It's the only reason I would bring charts up. But I wanted to use it as an example of how to explain that the stocks actually at this point are cheaper than they were a year ago. So if you were somebody that wanted to invest money a year ago, you still have that same opportunity, if not a better opportunity now, because the stock prices are actually cheaper on an earnings basis. So I thought that was an interesting chart to pull up there and just kind of go through and talk a little bit more specifically about, because that is a big question that I always get is, am I putting my money in, especially for people that have money sitting in savings, am I investing at a bad time? And, if companies are earning more money, that's always a good sign. So, that's reflective within the stock market right now. Next chart I have is a chart showing initial jobless claims going back through the beginning of 2021 here, and then it shows in a dotted line around 200,000 the 2019 average. So that was the average, weekly jobless claims that we saw in 2019, and that was kind of the number that we were hoping to get back to throughout the pandemic, or the start of the pandemic, with everybody being laid off and a lot of people filing for unemployment. So we, in the last handful of months, or really actually since November, the last handful of weeks, have gotten to that point where we're actually below the 2019 average. And I said earlier that unemployment rate is at 4.1%, which is very close to where it was before March of 2020, when COVID really kicked off. So that's a great sign to show from an overall economic standpoint, because more and more people are out there working. And it's a good sign to show that there's a strong labor market, meaning that more and more people are going to be getting paid more, because there's a lot of jobs that are out there that people at this point that are employees have more bargaining power, because there's actually more people that are just quitting jobs to go find another job because they can get more pay or whatever the benefits may be of them switching jobs. So that's a big surge right now, which is ultimately, from an economic standpoint, going to really help out from people spending more money and feeling better about spending more money because they can make more money. So for you as an investor, that's a great thing, because the companies that you're invested in benefit from people spending more money. And from an economic standpoint, the pricing, or the amount of money that those companies have to pay as far as salaries to employees, that number will go up, but that's not necessarily a bad thing, because these companies are able to pass on that cost to their consumers with higher costs. One of the reasons that inflation is going up right now. So not all inflation is necessarily a bad thing, because wage inflation is a good thing. Somebody that's now getting paid, instead of $15 an hour, $20 an hour, now all of a sudden is making a whole lot more money, 33% more money than they were maybe a year or two ago. And what that's going to do, from an overall consumer psyche standpoint, is that's going to make those people, number one, either want to spend more money, which generally is the case with lower income earners. They're not necessarily savers, they're more spenders. But for people that are in higher income brackets, generally speaking, those additional, income bumps that they get doesn't go into their, everyday lifestyle. That money generally gets saved and invested, which again is then a good sign for stock prices going higher. So both things are actually a good sign, whether consumers want to spend more money and not save it, or they want to save and invest it, because right now you can't just save it and put it in your bank account, because you're not going to make anything with it. So there's a big push of cash that will be heading towards stocks, because 2022 isn't going to be a whole lot different than 2021 as far as the rate that you're making on your savings account. Even if they start raising interest rates, which they've talked about doing, rates aren't going to skyrocket to a point where you want to leave your money just sitting in a checking savings account at the bank, because inflation is still going to dramatically outpace the amount of money a bank may pay you on money sitting in a CD or a checking or savings account at the bank. So keep that in mind. Last chart that I have is a chart kind of piggybacking a little bit on that economic unemployment chart, or unemployment claims chart before. This is showing the consumer confidence index going all the way back into the late 70s. So then in those gray bars there at different points in time, those are actually recessions. The last one we had here was in 2020, which was kind of like a little blip. Before that, we had the 2007 through 2009 recession, and before that we had the 9/11 recession in 2001. So you can see after a recession, generally there's a big hit to consumer confidence, because people aren't feeling as good about their overall economic position at that point. If you think about what happens during a recession, people get laid off, which just means that their income that they're making isn't there anymore, or potentially they may not get laid off, but they may not feel very confident about not being laid off. So versus right now, you can see some of the fluctuation that we've had here just be, from the sharp drop off during COVID to the then surge that we've had here this year, foul with some hiccups here and there. The most recent drop off was because of the Omicron variant that we've had, and before that really Delta variant that we had, with the concern that maybe the economy isn't going to do as well, and there's not going to be as much productivity because of a new COVID strain being out there. So that's the more recent drop off there. But I think that if you look historically, this is a really good, the spot that the overall confidence index is at a higher point, which is a good sign for the economy, showing that people feel really good about the position that they're at in their own, personal economic state. And it's also a good sign then for people to be saving and spending more money, which again, as an investor, is only going to benefit you from that standpoint. In 2022, I believe that stocks will see a little bit more of some extreme swings versus what we saw in 2021, where the market only had 4 pullbacks of no more than 5%. So that's really not that big when there's a 5% full pullback. That's really just a few bad days linked together. Most investment analysts, though, expect somewhere between a 6 to 12% rate of return for the S&P 500 for 2022, which falls into the average rate of return for stocks over the long-term period. Remember, long-term investing isn't about timing the market on when to invest money. It's about time in the market. The more time that you ultimately have with your money invested, the better growth historically the stock market has given those investors. If you'd like to link up here via Zoom this month, very flexible as far as doing Zoom meetings, feel free to just reach out to me and we can set that up and talk more to do a review if we haven't linked up in a while. If you have any questions or need my help with anything, don't hesitate to reach out, call, text, email me, whatever you prefer. If you have friends, family member, coworker, somebody that you feel would be interested in having a conversation with me about their investments, feel free to pass on my info to them. If they prefer me to reach out to them, get me their info, and I'd be more than happy to reach out and talk to that person. I appreciate you all for taking the time to check me out. Until next time.